Assignment. The wheel is primarily a cash-secured put strategy. Selling only cash-secured puts, continually scalping theta and never being assigned, is an outcome that couldn't lose. We only sell covered calls because we got assigned. CBOE research shows less than 10% of options contracts actually get exercised. Assign. Most option contracts are closed early, as do we, when trading the wheel. Assignment is somewhat equivalent to choosing to buy stock. Though the stock will currently be trading below the assigned strike, it is a stock we had already decided we'd be comfortable owning at that strike. Cash secured means the cash to buy assigned shares is already available in our trading account. We're approved for margin borrowing. We need to be sure we don't sell so many contracts as to overextend our borrowing exposure in the case of an assignment. In the money. When our sold CSP options go in the money during the course of a trade, the chance of assignment prior to expiration day is low because options carry extrinsic time value, usually right into expiration day. There's more profit, and it's easier for option buyers to close their option position for both extrinsic time value and intrinsic price gain than to assign stock for the intrinsic gain only, albeit surprise assignments can sometimes occur. If our sold options are ITM at expiration time, obviously, we'll get assigned the stock. Covered calls. Selling covered calls against owned stock is part of the wheel strategy, and assignment isn't a circumstance to be feared. But it does entail stock ownership risk because there's no knowing how low an owned stock's price may go. And thus, if a covered call right is going to pay enough credit to be worthwhile. Put selling against any number of favored stocks is always on, whereas call selling on an owned stock, at an equivalent call strike, the call strike equivalent to our assigned put strike, may not be viable at times. In that case, however, we can choose to implement an adjustment strategy. Call premiums. We take less premium for a covered call right, minimum 2.5% on average, for a 30 DTE trade. Calls may be selling for less than puts after a stock price down move, and our main priority is to be called away on the stock. When current stock price is close to the desired call strike, covered calls may pay significantly more than 2.5%. 2.5% CC income can be an average. A 2.5% covered call return on any stock, or stocks we own, is a minimum return, averaged over all stocks we may have been assigned. It may be 2.5% minimal return for the first right on an assigned stock. 2.5% minimum is averaged over a number of CC trades against a single stock position, for instance. 3.5% right on trade 1. 1.5% on trade 2. Is 2.5% average. 2.5% minimum averaged over a number of current stock positions, for instance. 1.5% on stock A. 2% on stock B. 4% on stock C. Is 2.5% average. Being able to place a next CC trade isn't always going to be worthwhile should IV drop or stock price go lower. At times it may be best to let the option expire worthless and take 100% of premium in the trade. Intrinsic stock price gains. We may have a choice to bet on writing for a 2.5% premium against a call strike even higher than the equivalent strike for a potential intrinsic stock price gain. The wheel is sometimes called a triple income strategy. Selling cash-secured puts, selling covered calls, profiting from intrinsic stock price gains. Selling cash-secured puts and covered calls are repeat income garnering strategies. Setting a covered call trade at a higher equivalent strike is a directional bet on stock price gain. To maintain our income garnering strategy, any directional bet for gain on stock price should only be taken when a minimum 2.5% CC premium is taken for the trade. On assignment, taking assignment choosing to be put, e.g., CSP strike at $50, the goal is 1. To get out of owning the stock, having it called away, at least at the same price as it being assigned, that is, $50. 2. To write covered calls for income against the assigned stock. In most instances, we'll be able to profitably trade out of assignment by selling covered calls as price rises back to the original assigned strike. When stock price is too low to sell a covered call, we can implement an adjustment strategy that makes a call right possible.